So we'll start the session today. Now, last week we did some questions and you asked me one valid question that was regarding the directions of central banks. You asked me whether you have to by heart the number of the direction. So let me answer with two real exam questions. September 2015, question number 6. The question reads, regulation on any business activity attempts to promote safety and soundness of the business, as well as protection to consumers. Among other objectives, outline the following regulations. So the question is, outline the following regulations on finance companies and their performance and importance for safety and soundness and consumer protection. Then there were 4 questions. I'll take what is relevant to the topic we are discussing by now. Number 4, finance companies risk-weighted capital adequacy direction. Now, when we move into the answer, it reads, finance companies risk-weighted capital adequacy direction. The finance companies are required to maintain a percentage of their risk-weighted assets in the form of capital to ensure that they are adequately capitalized to absorb potential risks. So, in this example, a specific number risk-weighted capital adequacy direction. But when we look into some other paper, March 2018, name the direction which stipulates the liquid assets requirement for licensed finance companies and indicate the minimum holding of liquid assets to maintain by LFCs in terms of time deposits, non-transferable certificates of deposits and savings deposits. There the answer reads with exact number. Finance companies liquid asset direction, number 4 of 2013, and what is inside. Okay. So regarding directions, please go through the note or the tute I have given. We discussed in detail about corporate governance, but read the other directions as well. And it's better if you can remember the number and the year. But even if you don't remember, then you can say direction regarding capital adequacy, direction regarding single borrower limit, likewise. Okay, so we'll move into today's session. Last week we started to talk about capital adequacy. Hope you can remember. Then we said what is CAR, capital adequacy ratio. Then regarding Basel committee, we discussed a little bit on Basel committee on bank supervision. We even looked at a picture of this Basel head office. Then we just talked about 2 types of capital, or the tier 1 and tier 2. We said core capital, supplementary capital, or total capital. Then we just talked about capital adequacy ratio. How do you formulate that? Tier 1 capital, tier plus tier 2 capital divided by risk-weighted assets. Then I said what is meant by risk-weighted assets, but we did not go into much detail. Now, tier 1 capital, elements of that, tier 2 capital, then the elements of that, risk-weighted assets. What do you mean by risk weighting? Why it is important? Now, capital adequacy ratio versus solvency ratio. I hope you can remember that we discussed these areas last week. Now, we are moving into capital adequacy ratio versus the solvency ratio. Both the capital adequacy ratio and the solvency ratio provides ways to evaluate companies' debt versus its revenue situation. So both these things we are looking at how much loans we have taken and how much we are earning. That applies to individual as well. If you have too many loans to service and if your income is lesser than that, then you are in deep trouble. So both these ratios are looking into that. However, the capital adequacy ratio is usually applied specifically to evaluate banks, while the solvency ratio metric can be used for evaluating any type of company. Now we have different subsidiaries. I said we have a subsidiary for fleet management. So for fleet management accountancy, we are not looking at capital adequacy ratios. But when that subsidiary is declaring dividends to the mother company, the finance company, that subsidiary is obtaining a solvency situation, obtaining a declaration on the solvency situation. So solvency ratio applies to any company, but capital adequacy ratio applies only to the banks and finance companies. The solvency ratio is a debt evaluation metric that can be applied to any type of company to assess how well it can cover both its short-term and long-term outstanding financial obligations. Solvency ratios below 20% indicate an increased likelihood default. We take loans. Some loans we have to settle in very short time. Some loans we take a long period to pay back. Now, as an individual, you may have a credit card and a housing loan and a vehicle lease. These three loans have different maturity stages, and you have to earn to service these three loans while surviving. The same applies to a company. So the solvency ratio below 20 indicates an increased likelihood default. Analysts often favor the solvency ratio for providing a comprehensive evaluation of a company's financial situation because it measures actual cash flow rather than net income. Now we have seen companies making profit, but cash flow is at a problem. Now, after COVID-19 effect, certain companies, say construction related companies, in their income statement, they have earned a profit. But the constructed or the construction projects which they have completed may drag the payments. Means what? In accountancy, in books, we can see a profit, but cash is yet to come and it's being dragged. Now, this is why this statement is very important. Analysts often favor the solvency ratio than net income. So you're looking at actual cash flow. Yes, profit is a number, but actual cash flow shows whether you can survive. Not all of which may be readily available to a company to meet its obligations. The solvency ratio is best employed in comparison with similar firms within the same industry, as certain industries tend to be significantly more debt heavy than others. Yes, certain industries take more loans than others. Construction. Then the companies that have to continuously upgrade, like IT, telecommunication, or even hotels that need continuous refurbishments, their debt ratio may be very high. Okay, now this is a cartoon that was published in a newspaper in the year 2008. The cartoon is showing some kind of anchored feeling against the bailout packages that was described there. Now this is what happened. If you don't have this, maintain these solvency margins or capital adequacy ratios, your bank will be in deep trouble when someone will come to bail out. Attention, If you are the ship's captain, its investor or manufacturer, we are here to rescue you. So bailout packages were criticized by these cartoonists. Anyway, we are yet to look into these possibilities. But I just want to say, if a company cannot honor the obligations, very soon the company will be running out of cash and the company will not be able to survive, like this ship. Generally speaking, these rules mean that the greater risk to which the bank is exposed, the greater the amount of capital the bank needs to hold to safeguard its solvency and overall economic stability. Greater the risk which the bank is exposed, the more the risk you undertake, the more you must be having capital. The greater the amount of capital you need. Means what? If you do very high risky businesses, the customers may default you. If so, if the customers do not pay back, you have to pass that liability to depositors. If you pass that liability to depositors, no more deposits will come to your bank, and very soon your bank will collapse. Therefore, you must maintain a shock absorbable amount of capital. So you are not passing the threat, the burden to the depositors. Instead, the shareholders bear it. In order to shareholders bear the risk, there must be sufficient amount of capital in the business. That's what we are looking here. The Basel III. Okay, we talked about the Basel Committee. We know where Basel City is situated, and this Basel Committee has released guidelines number 1, number 2, and now we are in number 3, are based upon 3 very important aspects which are called 3 pillars of Basel II. Right. These 3 pillars are minimum capital requirement, supervisory review process, and market discipline. Now you can just imagine the traditional cooking pot we Sri Lankans have, which was placed on 3 cornerstones. When you keep something on 3 cornerstones, that will not fall down, like the cooking pot. In the same manner, there are 3 pillars where the financial system stability is placed. As long as these 3 pillars are strong, the bank will remain stable. So what are these 3 pillars? Number 1, minimum capital requirement. You must maintain sufficient amount of capital. Supervisory review process. There must be a regulatory supervisory process. And market discipline. Market discipline means we believe the ultimate person to discipline a bank is the market. It can be stock market as well as the debt market. If a finance company or a bank publish its financial statements sharp on time, the investors, that is the shareholder or the depositor. Now these 2 people provide the liability side. Asset side is the loans that we give, the advances we give. Okay, so the more advances we give, the more loans we give, the more revenue we generate, we need more money. Who will give this money? By 2 markets. Equity, that's capital market, the shareholders. Then we have depositors, that is the debt market. They give us deposits. Now, when the financial statements show that the company or the bank is not doing well, will the depositors come and deposit in your bank? Say yes or no. When the financial statements reveal that the bank is making losses, will the depositors come and deposit their money with you? No. Right. No, that's right. Right. If a company is making losses, will the shareholders buy the share at a higher price? Say yes or no. No. Means what? Market is disciplining us. It's like taking your report card to the parent. Okay, so the parents read the report card and they will understand you. That is discipline. In the same manner, banks and finance companies have to publish their financial statements sharp on time and allow at the CSC website where everyone can access your data. Banks may publish their financial statements in newspapers, and finance companies also publish their monthly, quarterly statements, biannual statements, annual statements on newspapers. So the general public will know the situation of the bank. When the general public knows the situation of the bank, they know whether to deposit money or to buy more shares at a higher price or to do the reverse. That itself is a disciplining process. So the Basel III is based on 3 pillars. What are these 3 pillars? Minimum capital requirement, supervisory review process, and market discipline. Now the first pillar deals with measures of regulatory capital, that is minimum capital, for 3 major components of risks that a bank faces. So the bank is doing a very risky business. We are facing here 3 types of risk: credit risk, operational risk, and market risks. Other risks, there are other risks. They are not considered quantifiable at this stage. For the first pillar, that is to look at the capital adequacy, we are looking at these 3 risks: credit, operational, market. You can easily remember that as COM. We are in a .com era, so COM, COM, credit, operational, market risk. The second pillar, that deals with the regulations. Okay, so the second pillar, much improved tools over these available to them under Basel 1, 2, 3. It also provides a framework for dealing with all the other risks bank may face, such as systemic risk, concentration risk, liquidity risk, and legal risk, which the accordance combines under the title of residual risk. Okay, under pillar 1, we talked about 3 types of risks, so you can easily remember them. COM, credit, operational, market risk. Here we are looking into other risks which can be combined and use a nice blanket word, residual risk. So they are systemic, concentration, liquidity, and legal. One simple word covering all this 4, residual risk. Okay, so you have to remember these things. Right, so capital adequacy is something that gives the examiner a chance to check into more areas. When we were discussing about general insurance, life insurance, that's something very simple. You can easily understand. That's why I took it at the very beginning. Then we completed very simple subject areas. Now we are looking into something where you have to try to understand. We are looking at Basel 3 pillars. So the Basel committee has come up with 3 types: Basel 1, Basel 2. Now we are engaged in Basel 3. There are 3 pillars. The first is on capital. The second is on supervisory. Third is on market discipline. The first pillar, we talk about 3 risks. You can easily remember .com, credit, operational, market. Second pillar, we are looking into 4 risks or the other risks that are system, concentration, liquidity, legal, and one simple word to blanket them, residual risk. Third pillar, the third pillar greatly increases the disclosures that a bank must make. Okay, the statements that you have to publish, that is the disclosure. This is designed to allow the market. So what is market? Debt or equity market, to have a better picture of the overall risks position of the bank and to allow counterparties of the bank to price and deal appropriately. Yes, what are you going to price? If it's a share, market will make the share go up or make the share come down. That gives a message to the bank. Okay, we are well managed, therefore our share price is continuously going up. Our share price is continuously going down, something wrong somewhere. Our shareholders are not happy with that. So these are the signals the management will get. The third pillar requires the bank activities to be transparent to the general public. For this, the bank is supposed to release relevant financial data, financial statements, etc. in a timely fashion to the public. For example, through its web page. Okay, Colombo Stock Exchange, there is a web page and your statements will be published there, and that is available to the general public to view. This might enable depositors to better evaluate bank condition, example, bank probability of failure, and diversify their portfolio accordingly. As such, this pillar by itself is believed will enhance the role of market discipline in the financial markets. Okay, so market discipline is like releasing your report, your performance report. Right. Now, in CSC, Colombo Stock Exchange website, there's a default board. That means these companies have failed to issue their statements sharp on time. Their statements sharp on time. It's like in a notice board, putting your name as those who are late to submit an assignment. Means what? You are named and shamed by publishing your name in that notice board. That is discipline. Okay. Now let's assume you are doing a MBA or the professional course. You are asked to submit your assignment on 20th, and on 22nd they will publish in a notice board the names of students who have failed to submit the assignment sharp on day. Means what? You get shamed to see your name there. That will discipline you not to do it again. That is a market discipline. That is disciplining you. Doing that in the market is market discipline. Okay, we'll talk a little bit on market discipline. Right. Now, one important aspect of market discipline is it will remove the weight from the regulator's shoulder to the general public. When a finance company fails, when a bank fails, the general public always blame the regulator. Hey, you have not regulated this company well. But it's your duty to shoulder that risk. Okay. Now, there was a nice Sinhala website, Randiva, and that website is normal. However, they ran a very nice article. They looked at two companies that failed. And in these failed companies, when they were on the wrong path, they have put advertisements taking cricketers, okay, to canvas deposits. One is Statute, so I can name that. The other is a finance company. And the cricketers appeared on the advertisements included Sangaka and Sanachai Surya. They have put this advertisement and said, it's like a joke. They have said, here, when you look at the cricketers appearing on advertisements on these companies, instead of looking at credit rating, you will be at risk. Okay. So the expectation of the authorities is market will go through these advertisements and look at credit rating, not at the person who is appearing on behalf of this company. Okay. I can remember another example. Yes, that was there. Aidangani Sevasinghe appeared in an advertisement. And later, that finance company faced some problems. Are you looking at the cricketer or the actress or the actor or the credit rating given to this finance company? Okay, so market discipline means market will be provide enough data to analyze. If the market does not analyze, that's another problem. So market disciplining means even in the advertisement, whether Aidangani Sales appears, so Sanajay Sudhi appears, credit rating of the bank is given or the finance company is given. You have to look at that and decide whether to deposit more of your money. Right, market discipline. Bank managers have strong incentive to be involved in risky activities with deposits entrusted at their disposal. What is that? Bank managers want to see that their branches are making huge profits. The entire bank will prefer to show very high profit this year. In order to do that, you will undertake very high risky businesses. Higher the risk, higher the interest rate you can charge. The more the interest rate you can charge, the more the profit the bank will show in their financial statements. But we must understand one thing. When we give loans to risky parties at a higher interest rate, we are undertaking a very high risk as well. And this risk will be entrusted to the depositors. This is mainly due to the bank balance sheet structure and the safety nets existent in financial markets. Okay, now why do the managers undertake very high risk than any other industry? The reason is balance sheet structure. I have discussed already in the bank's balance sheet. If you look at the liability side, capital is a very small percentage. The higher percentage belongs to depositors. Therefore, I can play with others' money. So that is one. The other is safety nets. Safety nets mean when a bank collapses, there are many parties who want to see that it survives. So they are coming up with bailout packages. That happened in year 2009 in US as well. Nevertheless, the bank depositors can simply withdraw their funds or ask for higher deposit rates when realizing the bank they are investing in taking excessive risk. Now that's what happened. Whatever the safety nets you have, okay, you have deposit insurance schemes, that's a safety net, bailout packages, that's a safety net. Irrespective of all these, the depositors demand either very high interest on the deposited money when they feel that the bank is undertaking very high risk, or they may simply withdraw their money. That will send a message to the management. The idea of depositors monitoring and influencing the bank risk-taking activities is known as market discipline in the financial economics literature. So market disciplining means the depositors who are monitoring the bank risk activities and decide on interest rate they want from the bank as well as whether to withdraw money from the bank or not. One might suspect if this is in fact the case and whether market is disciplined really exists or not. After all, deposits are under some sort of government guarantee anyway. Now that's there. Even though what we think that customers, the depositors, will discipline the managers, the depositors simply don't look at the Fitch rating or any other credit rating. They don't even look at the income statement, balance sheet, published in national newspapers. Instead, they just watch the TV advertisement, look at the actor, actress, or the cricketer, then come and deposit. They believe if the bank fails, my God, the government will come and bail out our money. The government guarantees there. That's what they want to say. We want to say market should discipline us, but the depositor says, no, the government is there to bail out us. In fact, there are even implicit insurance schemes like too big to fail, where regulators in central agencies feel obliged to rescue a troubled bank with fear of financial contagion. Okay. Dominoes effect. If one thing falls on another, that will fall on many other things and the entire system will collapse. In order to prevent that, we will somehow ensure that the big guy is not falling down. Big guy is falling down, but we want to stop. Because if the big guy falls down, many other companies will fall down. So this is what meant by too big to fail. Why the government interfere and ensure that the too big guy does not fail is fear of financial contention. Why? Then the depositors bother to monitor bank activities under these favorable circumstances. Therefore, making the relevant financial data publicly available in a timely fashion will supposedly help investors to better evaluate bank condition by themselves. And as such, this will relieve the pressure of regulators and put it on the shoulders of market investors and depositors. Yes, on the share market and the depositors, the regulator prefer to pass their responsibility. Now, one simple question. Now you will understand capital adequacy. Why do you need it? Okay. If a company is undertaking too high risky businesses, it may show profit, but cash generation will be a risky job. When cash generation is risky job, what will happen? The company will not be able to pay back the depositors' money. Then we believe government should intervene, that's the depositor. We believe the depositor should read the financial statement and withdraw or ask high interest rates, sending signals to the management. That we is the regulator. Okay. Now, my simple question here from you. Do you tell me, there's nothing wrong, just tell me your honest answer. When you are depositing money in a bank, do you really read financial statements? Say yes or no. When you are depositing your money in a bank, do you really look at financial statements? Say yes or no, that's enough. Just say yes or no. I'm not asking any further question from you. When you are depositing money or when your mother is depositing money, are they looking at financial statements? No. Means what? We believe that is happening, but it is not happening. Okay. Even the same with share market sometimes. In share market, we believe people go through the published statements, that's why the statements are published, and buy the shares. But there are many companies that are on default board, but still people buy shares. Okay, they buy on some instinct, some gossips instead of published financial statements. If that is happening, then market discipline is not taking place. Okay, we'll go ahead. The right amount of information released is essential. Okay, in order to discipline, the right amount of information should be released. If we have too little, then we can't understand. If there are too much, we will not be able to read the entire thing. So there are standard formats of publishing statements. Now we talked about COM. That's the first pillar. Credit risk. Credit risk is the risk of loss due to a debtor's non-payment of a loan or other line of credit. Okay. So credit risk is customers' inability to honor the obligations. So he is not paying either interest or capital or both. Operational risk. Operational risk is a risk arising from a company's business functions and from the practical implementation of the management strategies. Okay, so that includes information, frauds, physical or environmental risks. Okay, so COVID, frauds, information. Okay, I think last week we came to know some very good websites were hacked. So we are facing that operational risk, information risks. Market risk. Market is going up and down. That's a risk. The market risk is the risk that the value of an investment. Okay, I'm investing 20 million in share market and tomorrow I will find the amount has gone down to 2 million. That's a risk I'm undertaking. Right. So the market risk factors can be equity. That's about the stock prices. I'm buying stocks worth 20 million and tomorrow I'll find it has gone down to 2 million. Interest rate risk, or the risk that the interest rate will be changed. Okay, I'm taking a loan at 16% fixed for 5 years, and after 1 year I find the rate has gone down to 16%. Interest rate risk. Currency risk, or the risk that foreign exchange rates will change. Okay, I purchased dollars at 189 and it has come down to 180. Foreign exchange risk. Commodity risk. Commodity prices, grains, metals, oil, anything. Okay, so I delayed purchasing tiles for my house. All of a sudden I find floor tile price has gone up. Commodity risk. Credit risk, or the risk that credit spreads will change. Okay, there's a difference between accepting loans, giving loans, that interest rate, and the deposit. Okay, what I'll do is I'll take a deposit at 16%. Okay, I'm the bank. One of my customer, that is you, come to me and make a deposit of 1 million, and I agree to pay you 16% for 4 years. And against that, so I take this 1 million and give a loan to a customer at 21%. So I'm making 5% difference. That is the spread. Now, after 1 year, interest rate has come down to 12%. Lending rate has come down to 12%. Okay. Now what has happened? I am paying 16% to the depositor. Now the customer who took the loan is negotiating to reschedule at 12%. When I don't agree, he settle it and go to another bank at 12%. Now without interest, or with 12% interest earning, I'll pay 16% as promised to the depositor. That is a risk I'm undertaking. That is called credit risk. Right. Once again, capital adequacy. Now you know that there must be enough capital to cushion, to absorb losses. Now we know the areas there can be losses. So when you are running a vehicle, there are shock absorbers. Shocks should be absorbed, cushioned. For that, you need capital adequacy. If you don't bear that, then we have to pass that to depositors. The moment we pass that to depositors, there won't be any further deposits coming to us, and that is the end of our business. So we don't want to see that. If so, there must be enough capital to cushion or absorb losses. Capital requirements are necessary to prevent banks expanding beyond their limits. Okay. Banks want to do more and more business. If you're a bank manager, what do you want? You want to do more and more business that's growing. And you want to see your revenue, the top line is growing fast and fast. That is your expectation. But when you're undertaking more growth opportunities, that means in your balance sheet, A side is going up, assets are going up. When assets are going up, your liabilities should also go up. A equals C plus L. That is the accountancy formula. If A goes up, then C plus L should go up. We prefer to do more business with deposits, more deposits and more loans, and my capital will remain constant. Means what? If that loan advances, default, that should be borne by depositors, and depositors are not ready to do that. Okay, so I have seen in Islamic finance you talk about profit and loss sharing. That's a very good concept, but are you ready to share losses? No one. And you are free to withdraw your money when I am asking you to bear my loss. You are there to share my profit, but not to bear my loss. That is the risk we are undertaking. The importance of capital adequacy is indicated by development of an internationally accepted measure Basel with the risk asset. This approach defines the elements of capital for supervisory purpose. Right. Last week also we said, when we say assets, the loans we have given become our assets, as well as some physical things we have acquired, some tangible things we have acquired become our assets. Okay. So for the bank, when I'm giving a loan, that is asset. When I'm purchasing a computer to do the banking activities, that is an asset. When I'm purchasing a land and building, that is asset. When I'm purchasing shares of other companies, that is asset. When I'm purchasing government debt securities, treasury bills, treasury bonds, that's a security. That's asset. Okay, these assets have different risks. So if I purchase government securities, there is no risk. But if I give loans to other banks, there is a risk. If I give loans to customers based on the loan, there will be another risk. So these risk percentages can be utilized to weight the assets. For the bank balance sheet, you have asset side, liability side. A equals C plus L. Assets can be loans to customers. That is our main business. So a greater percentage will become loan receivables, LRR, lease rental recoverables, credit card rentals recoverables, loan advances recoverable. So all the loans that we give away becomes an asset. Investments. Being a bank, we may invest in other companies' shares. That's asset. We may invest in government securities, treasury bills. That's asset. And we have to maintain a certain amount in cash and in the cash form. That is asset. So these are the assets of a bank. What are the liabilities? Capital. Capital consists of money from ordinary shareholder plus retained profits. Then debt become the loans we have obtained from other banks, deposits from public, and debt securities. Okay, widely accepted, though a national authority are free to impose higher standard on their banks' credit risk weighted. In Sri Lanka, the present total capital ratio, that is tier 2 or supplementary ratio, I have mentioned X percentage. Earlier, that was 10% and core capital was 5%. Now that has changed. We'll look into that regarding finance companies, because we are talking about NBFIs, licensed finance companies with assets less than 100 billion. So by July 1st, 2018, tier 1 capital should be 6%. And the tier 2 capital or the total capital should be 10. By 2019, July, 6.5, 10.5. By 2020, July. So by now, your core capital is 7% and the total capital is 11%. And we have to move up to this level. Anyway, during COVID-19 period, there were certain relaxations on this, but this is the expected. And in order to ensure that even banks and finance company may decide on the ability to declare dividends. Now, licensed finance company with assets of 100 billion or more. So that was 8% core capital, 12% total capital. Okay. So for exam purpose, remember 8, 10, 12. Core and supplementary capital requirement for finance companies about 100 billion assets. Right. Now we are looking at why it is important for having this standard across the world. Strengthen the entire world banking system. Okay, remember what happens in a well-developed nation will affect the entire world. For example, America. We normally say if America catches cold, we may end up in pneumonia. Okay, if America catches cold, we may end up in pneumonia. To that extent, The entire world is connected. In 2009, the financial crisis really happened in US, nowhere else. Subprime mortgage price took in US, not in Sri Lanka. But by 2009, we were facing lot of financial problems. We could not sell tea, rubber had no price, no tourists coming. Voice one thing, that's unique to us by that time. But the rest, say there were no demand for many rubber manufactured products because the cars are not manufactured much. Why? Because the existing cars in the world were not in a position to be sold out. Okay, so this is the impact. That's why we want to see the entire world's financial system remains strong to ensure that the banking across the globe would enable to withstand any problems, to provide an equal base for banks in the world to compete, to remove incentive a bank may have to relocate another country due to leniency and regulations. Okay, so if there are less regulations, we prefer to do business in that country. Right. For exam purpose, remember this slide. What are the elements of tier 1 capital? Or what are the elements of core capital? You must remember this. Paid up ordinary shares, non-cumulative, non-redeemable preference shares, statutory reserve fund, published published retained profit, general and other reserves, unpublished profit. Yes, then there must be number 7, published profit or losses. So that's the core capital. If there's goodwill, you have to remove that. Then the elements of tier 2 capital, revaluation of reserves, general provisions, hybrid, that is redeemable cumulative preference shares, minority interest, approved subordinate term. Okay, right. Now we are looking at calculation of tier 1 and tier 2. Okay, so what is tier 1? The elements of tier 1. What are the elements of tier 1? So you must remember these things, then you can answer instantly. Elements of tier 1 capital means paid up ordinary shares, statutory reserves, general reserves, unpublished profit and loss account, published profit and loss account, and non-redeemable, non-cumulative preference shares. So likewise, you must be able to answer that. Then tier 2 capital, that is divided by the risk-weighted assets. So the assets are classified into different risk weightages. 0%. If you have cash, there's no risk at all. So likewise, 0 risk assets. These are assets, but we don't see any risk of holding them. Means what? There is less return as well. 10%. Loans guaranteed by OECD countries. OECD means Organization for Economic Cooperation and Development. So there are countries like USA, UK, Canada, Japan. So if the Japanese government guarantee a loan given by our bank, that risk is just 10%, because we believe government guarantees are really acceptable in those countries, and 20% for non-OECD countries, 50% for loans secured by property mortgages, then 100% on risk of these things. Then there are some off-balance sheet items. Right. Now, how do you calculate it? Tier 1 capital divided by risk-weighted assets into 100%. Tier 2 capital, or the total capital. Tier 2 capital divided by risk-weighted assets. Okay. Right. Now, we have covered capital adequacy. You have an understanding of it. Now we may look into the reading material I have given you. Just go through it. This is the chart I have given you already. So if you think about a bank, about licensed finance company, about 100 billion assets. By 2020, you must have tier 1 capital 8, tier 2 capital 12. Okay. Regulator reporting. Now, why do you want to report? Market discipline. Every licensed finance company shall submit details of computation of capital adequacy requirements through the web-based system in accordance with the formats. So there are formats given: monthly, annually. Okay. So if you fail to do that, okay, non-compliance. In the event of non-compliance, this will be the result. Restrict distribution of dividends. Suspend any business activity. That will further deteriorate regulatory capital position. Okay. So the regulator will take serious actions. Now, if you don't publish your capital adequacy ratios, what can the regulator do? Yes, they will ensure that you are not in a position to declare dividends. Right? So shareholders will get affected, or certain business activities will be restricted because that will deteriorate the situation further bad. Now, director means director of Department of Supervision of Non-Bank. Now, regarding the schedules. So you can go through this in your free time. Tier 1 capital. This represents core capital. That is the shareholders' equity and reserves. Okay. So the core means the capital which is relevant to the shareholder. Shareholder will remain as long as the business survives. So that capital affecting to him is core capital. So that is shareholders' equity and the reserves. Then the tier 2 capital. This represents supplementary capital. So you can be asked what are the elements of core capital, what are the elements of tier 1 capital, or you can be asked what are the elements of supplementary capital, or what are the elements of tier 2 capital. So containing characteristics of equity and debt, that is preference shares, revaluation gains, and general provisions, impairment allowances. Now risk-weighted assets, RWA. So they are calculated in these formats, standardized or basic indicators. Now capital buffer for larger licensed finance companies. What do you mean by larger? More than 100 billion. Now these are the capital adequacy ratios. Okay, so when you are submitting, this is how you have to do it. Now this is how you calculate and send it. Tier 1 capital. So what you have? What are the elements of tier 1 capital? Stated capital, that is what we said, paid up, authorized ordinary shares. Non-cumulative, non-redeemable preference shares, reserve fund, audited retained earnings and losses. Less, okay, then current year profit and loss. Then that aggregate amount, we will reduce this amount, goodwill, other intangibles. Then you will get it. Then instruments qualified to tier 2 capital. Okay, so in our slides we have what are the elements, so a further explanation on that. Revaluation surpluses, 50% out of that. Okay, then computation of total risk-weighted assets. So one side is your A side, asset side. The other is your C plus L. So we are looking at C. C is divided into two. We have C1, T1, T2. And now we are looking at the other side, A, assets. Assets are risk-weighted. Now we have CRM, credit risk mitigations. Then the ratings, Fitch, Moody's, Standard. Okay, now we can get some kind of understanding of these ratings. AAA to B minus. Then there are unsolicited ratings. Right. Okay. Now I have given you the slides. Go through the slides. Now I am giving you the reading material. When you are reading material, yes, just have a look at it. Certain areas like what are the elements of tier 1 capital? Compare that with the slide I have given. So you can remember easily. What are the elements of tier 1 capital? That's a probable exam question. Paid up, authorized, ordinary shares. Non-redeemable, non-cumulative preference shares. Statutory reserves, general reserves. Unpublished profit and loss account. Published profit and loss. Okay. So likewise, you can compare these two. Now, in the latter part of my slides, I have given computation of risk weighted. Okay, so what are the risks weighted? Government, okay, claims on government, zero risk, that's government securities. Okay, so these are zero risk. Then for banks, based on the credit rating. So if you have total performing claims of a bank of AAA to BBB minus, risk weight is 20%. Below B minus, 150%. Unrated, 100%. Below B minus, 150%. So these are the risk weightages given. Okay, so for loans given to companies, loans given to finance companies, retail claims, and these claims, right? So the claims that failed to comply with other notes, you are charging 125. Okay, later on I'll discuss them with some examples. Okay. Then CRM, credit risk mitigation. Okay, now don't get afraid of this area. Okay, simply go through the slides. That is the easiest way. Then just to improve on your knowledge, go through this direction, right? So what you will find in the direction, I have given you the summary format in the slides. Right. For exam purpose, there are a few questions that may be repeatedly asked. I'll deal with that later. For an example, what are the elements of these? tier 1 capital, tier 2 capital. Then why do you need capital adequacy? Then in one paper, there was a simple calculation of capital adequacy requirement. Okay, tier 1 capital, what is the percentage? Tier 2 capital, what is the percentage? There you have to do the calculation. So you should know these items apply 0% risk-weighted assets. Loans which are not collateralized, 125%. So likewise, you must remember the percentages. We'll discuss that with the exam paper later. For the time being, just remember to go through the slides carefully and just have a look at the direction. Now the second part, credit risk mitigation. CRM. In this subject, CRM means credit risk mitigation. In marketing, CRM may mean customer relationship management. Okay, so here we are looking at, in this subject, CRM means what? Credit risk mitigation. Right. So there is a risk whenever we are giving credit. So we want to mitigate that, reduce that. Licensed firm finance companies use many techniques to mitigate the credit risks to which they are exposed. For an example, exposure may be collateralized by first priority claims in whole or in part, or in part with cash or securities. A loan exposure may be guaranteed by a third party. Additionally, licensed finance companies may agree to net loans owed to them against deposits from some other counterpart. Means what? When we are giving a loan, we want to ensure if the loan taker defaults, what can I do? That is the credit risk mitigation. So we are looking at collateralizing. Right. If you fail to pay back, do you have asset to collateralize? If not, a third party guarantee. If not, something to set off. That's what we are looking at. Number 2, credit risk mitigation allows a wide range of credit risk mitigation options to be recognized for regulatory capital purpose, provided that these techniques meet the minimum conditions described below. While the use of CRM, now you know what is CRM, credit risk mitigation techniques, reduce or transfer credit risk, it simultaneously may increase other risks, residual risk. Now you know what is residual risk. Okay. First pillar.com, second pillar, residual risks. Now residual risk is a blanket term. We said that include legal, operational, liquidity, and market risks. So you can go through the slides again and look into what is market risk, what is liquidity, what is operational. Therefore, it is imperative that LFCs employ robust procedures and processes to control these risks, including strategy, consideration on the underlying credit, valuation, policies and procedures, systems, control of roll-off risks and management concentration, risk arising from LFCs using CRM techniques and its interaction with LFC's overall credit risk profile. The total exposure of eligible collateralized transactions and other CRM techniques should be reported in their return. Any non-eligible collateralized transaction and other CRMs need to be reported in part 2. Okay. Right. So credit risk mitigation. In order to do that, we ask collaterals or securities from a person who wants to take a loan from us. Treatment of pools of CRM techniques. Now these are them. In cases where a licensed finance company has multiple CRM techniques covering a single exposure. Example, a licensed finance company has both collateral and a guarantee partially covering an exposure. Licensed finance company will be required to subdivide the exposure into portions covered by each type of CRM technique. Example, portion covered by collateral and portion covered by guarantee. And risk-weighted assets of each portion must be calculated separately. When credit protection provided by a single protection provider has different maturities, they must be subdivided into separate protection as well. Total CRM exposure. Total exposure of eligible collateralized transactions and other CRM techniques. The exposure with zero risk-weighted CRMs reported in this part should not be reported in any other part. in the other part of the capital requirements in return. Collateralized transactions. Collateralized transaction is one with licensed finance company have a credit exposure or potential credit exposure, and such exposure is hedged with whole loan in other part by collateral posted by a counterparty, by a third party on behalf of the counterpart. Okay. Right. So we are looking at something different than what we have discussed so far. Okay. And the terms we are using may be more technical than earlier. We are just reading a direction given by central bank. Okay. And whenever we are giving a loan, we undertake a risk. We want to mitigate that. Credit risk mitigate. In order to mitigate, we ask a security. This security can be an asset or a guarantee by some other person. Okay. If this person does not pay, I'll pay. That is the guarantee. Sometimes the same loan can be partially guaranteed by a third party and partially collateralized by asset. If so, how do you do that? The simple approach will be followed in computing the effects of CRM. Simple approach. The portion of claims collateralized by the market value of recognized collateral receive the risk weight applicable to the collateral instrument. The risk weight on the collateralized portion will be subject to a flow of 20%. Exemptions from 20%. So when you have collateral in cash, government security, then the exemption of 20% is there. Minimum conditions. All documentation used in collateralized transaction and guarantees must be binding on all parties and legally enforceable. Ability to liquidate. So you must be able to liquidate and take legal possession. Material correlation. In order to collateral to provide protection, credit quality of the counterparty and the value of the collateral must not have a positive correlation. Recovery procedure. Licensed finance company must have clear and robust procedures for the timely liquidation of collateral to ensure that any legal condition required for declaring default of the counterparty and the liquidating the collateral are observed, and that collateral can be liquidated promptly. Where the collateral is held by the custodian, licensed finance company may take necessary reasonable steps to ensure that the custodian segregate the collateral from its assets. Okay. Cash, government securities, equities, guarantees of right. Then there is a simple calculation of this. Right. Okay, I know the first set slides were easy to understand, and I've taken mostly from the second part, the direction. So you can go through the slides first, read it carefully, understand. Later on, in your free time, go through this direction. Right. Now, last week we did some questions, and today we will continue with another area. Okay, so last week we discussed with unit trusts. Our question area was on unit trusts. Now remember, we have covered almost all relevant areas, and by now even capital adequacy we have covered. What we have to do is some exercises that we will take time and do. Anyway, go through the notes first. Unit trusts, I was very happy with the way you answered. And the second hour, the first hour we are on theoretical areas. Second part, second hour, we looked at some past paper questions. So that will ensure you to have good marks at the exam. So I'm taking another very simple subject heading today, insurance. Okay. Write down. Describe 3 types of general insurance products. Write your answer and send me like last time. Describe 3 types of general insurance products. Simple question. So I want you, you can look at the chat box. I want you to answer this question. Okay. Last week I got answers from 3 students. That's good. I want to see answers from others as well. Please send me answers now. Right? The chat box and send me now. So you have marine insurance, covers damages of a ship cargo between the travel destination. Title insurance, very good. To protect against if a clear title deed is not available, which is usually obtained by the lenders. Fire insurance covers any damage aroused due to fire. Very good. I'll give a few more minutes and I want to see answers from others. Now, my dear, I know when you are just listening to me, especially the first few months, when I'm talking about stocks, when I'm talking about venture capital with stories, it's really it's lovely to hear it. But when I'm giving a question and you have to answer, I know it's not that interested. But your marks will not depending on the nice stories which I have told you. It depends on your ability to write an answer for the exam question. So take the advantage now. Okay. For others, there are many other general insurance products. Vehicle insurance, liability insurance, health, yeah, many other insurance products. I'm giving you a few more minutes and I want to see answer from someone else as well. There are many general insurance products we have discussed. Burglary, theft, yeah. Okay. Right. I'll give you another one. Describe how insurance companies protect them from liability risk. I know this is not interesting, but this is a must. Okay. Send me your answers. I see answers from 1, 2, 3, but I want answers from others as well. Describe how insurance companies protect them from liability risk. Dilshani, very good. Nadini, good. You have explained, very good. Others, try to send me your answers. Now, when this answer gives you 5 marks, I said add few more lines. Reinsurance, where a portion of the risk portfolio is transferred to another insurer in order to mitigate paying large obligations arising due to insurance claims. So likewise, add few lines. By stating reinsurance, yes, of course, you will get 1 mark out of 5. But in order to get good marks, you want to add every possible mark. When you know the answer, when you know it's reinsurance, yes, why can't you write few more lines? Anyway, I'm happy with the answers of 3. Next, insurance premium of a life insurance policy depends on several factors. Describe 3 such factors. Yes, others, there are many factors. Tell me some of them. Health history, yes, and you describe that, very good. Hobbies, then you describe that, good. Age, very good. Tell me some other factors. I can remember when I was lecturing about this, I talked about gender. I asked whether who will live more, male or female. Okay, so gender is there. What else? Occupation. I said certain occupations are very high risky. Okay. Then I asked about the habits like smoking, hobby something, habits like smoking. So these are the factors. Right. So these 3 are very simple, and I'm happy with the way you answer. Then I'll take yeah. So that was from March 2015. Then I'll give another question from the same paper where you may think a little bit and answer. I said the examiner is very interested in checking under one topic, the known areas. and something, say, surely discussed in the class, and something which you may have problems whether we have really discussed this in the class. So examiners love to add one such question. So this time, describe 3 primary functions of insurance. Describe 3 primary functions of insurance. Try to answer this. Describe 3 primary functions of insurance. Something to think, not a very difficult question, very simple thing. But yes, we have not discussed in that format, but you know the answer. Something to think, then write the answer. You wanna guess would work. Try to write something. Just think and write. Yeah, very good. Provides. Yeah, okay. 3 primary functions. You can add another. Very good, Nathini. Since there are 3 primary functions, try to add one more. Yes, provide protection, that's there. Collective bearing of risk. Collective bearing of risk. Provide certainty, that's there. Small capital to mitigate larger risk. So you said small premium to mitigate huge risk, okay. Then collective bearing of risk. Collective bearing. So we all contribute, but only 1 or 2 will really get the need to claim. Collective bearing. Okay, right. So these are the 3. Now, the beauty of doing past papers is you will find some repeated questions and some questions like this that were not discussed in the class. Okay, right. So I'll take another paper. Differentiate between long-term insurance and general insurance by giving appropriate examples. Differentiate between long-term insurance and general insurance with examples. Once again, another simple one. So you need not to write the answer, just listen. Insurance premium of a life insurance policy depends on several factors. Name and describe any three such factors. Almost the same question repeated. So this is the beauty of doing past papers. Certain questions are repeated, then you can prepare very well. Certain things you have to think and write. Okay, then I'll add some other questions from insurance area. How does the deposit insurance differs from general insurance? How does the deposit insurance differs from the general insurance? Okay, deposit insurance part of the safety net mechanism which protects, very good, against failure of financial institutions. General insurance is insurance of products for other than life, very good. Deposit insurance compensate the bank depositors, very good. General insurance compensate all products other than life, very good. Two superb answers. Okay, now the other question is a repeated one. What is the difference between bank assurance and reinsurance? You need not to write, you know the answer. So in every paper, you will find repeated questions. Okay. So one way of preparing for the exam is take a topic. You need trust. Take all the possible questions. Write your answers. Check with the model answers. Then you can easily prepare for it. Now we have taken insurance today. We are doing the same with insurance. Then I'll give something to think and mix with what we discussed today, solvency, and right, still under insurance. Outline the statutory solvency margin and its importance as a prudential measure. In banking, we talk about capital adequacy. In all the other industries, we talk about solvency margins. Okay. First, look at the slides of today's lesson, then think a little bit and try to write something. I'll give you 7 minutes. Until 9:45, I'll wait. Prudential means long term. So when you can bear an unforeseen event, that's because you have taken the prudential thinking. Now the answer of nothing reads like, the solvency of an insurance company refers to ability to meet its insurance claims. Okay. Hence the retaining the minimum amount of assets. or capital over its liabilities would ensure that the insurer is prepared to meet any unforeseen events. Correct. So you are preparing for any unforeseen events. Number 3, since insurance is a risky business, it is necessary to maintain solvency margin to maintain stability in the industry. Very good. Right? I'll read out the model answer so you can add anything you want. Statutory solvency margin is a minimum excess. Okay? It's a minimum excess on an insurer's assets over its liabilities by regulators. The solvency of an insurance company corresponds to its ability to pay claims. Investors measure the company's ability to meet its long-term debt obligations by looking at the solvency margin. An insurer is insolvent if its assets are not adequate or cannot dispose in time to pay the claims arising. It is the extra capital that the insurance company is required to hold as stipulated by the regulator. Both life and general insurance companies need to maintain solvency margins. So the first paragraph describes about solvency. Insurance is a risky business where uncertainty prevails. Unforeseen events might occur sometimes, resulting in higher than anticipated claims. In such instances, if the liability is large, the insurance company may become insolvent, creating instability in the insurance sector. Solvency margin is aimed at averting such a crisis. The extra capital required to be held by the solvency margin stipulated by the regulator ensures that the policyholders are protected against unforeseen events. Yes, so that's going to be the answer. Nadini, your answer is accepted, and that is the level of model answer. So others, we discussed about solvency margin, capital adequacy, then link that with what you know with the insurance and write. Then I'll give another question. Okay, in this paper, another question was, what is the difference between bank assurance and reinsurance? Again and again repeated. How does the deposit insurance differ from general insurance? You already answered. Outline the statutory solvency margin, you said that. Then I'll give another question to think and write. Outline the basic operational mechanism of the conduct of insurance business. Outline the basic operational mechanism of the conduct of insurance business. Once again, I'll give you 5 minutes. Try to write something. Right, so the operational mechanism is collecting premiums as much as possible, invest them, and pay claims. Okay, so I'll read the model answer. The basic operational mechanism of an insurance business is to collect more premium and invest income than pay out its losses and underwriting expenses. Insurer's income is made up of 2 components. One is the premium collected through underwriting. Example, the process by which insurers select risks to insure and decide how much in premium to charge for accepting risks, actuarial job. Other is income earned by investing the premiums they collected from insured parties. The most complicated aspect is to set price for the policies, which enables the insurer to cover its risks and costs while being competitive in the market. For pricing the policies, the insurer uses statistics and probabilities to approximate the rate of future claims based on given risks and probability of loss. Upon termination of a given policy, the amount of premium collected minus the amount paid out in claims is the insurer's underwriting profit on that policy. Some risks are reinsured by the insurer paying a premium to the reinsurer. Right, so that is the operational mechanism. Right, now you can see the importance of doing past papers. Some questions are very simple and repeated. Some questions you have to think and write, and that is not difficult. Say this operational mechanism of insurance. you know it, then you have to write something. Sometimes we may mix with two areas, solvency margin plus insurance. Okay. Then describe three types of general insurance. You know that. What is the difference between bank assurance and reinsurance? You know that. Describe deposit insurance scheme in Sri Lanka and how it mitigates losses to the depositors. Okay. Describe the deposit insurance scheme in Sri Lanka and how it mitigates losses to the depositors. I think you can write something. And I'll give another question. What is gross written premium? What is gross written premium? What is gross written premium, GWP? The premium collected before deducting an insurance commission. Yes, the sum of both direct premiums written and assumed premiums written before deducting ceded reinsurance. Very good. So I got answers. Right. So today we discussed about capital adequacy, and latter part we went into exam questions. Yeah. Navini, I'll take up this next week, right? And let me just sum up what we are doing. Now, almost all relevant areas we have covered up. What remains to complete is cooperative societies. I'll do that next week. Then we may look into question and answers of the areas we have done so far. Now, I can see the status of at least 3 students, but rest I do not know. Right. So from the rest, I'm asking you, please go through these slides and discussions, prepare for the exam. For your exam now, you know you have a structure, question number 1, MCQ and short answers, question number 2 onwards, one subject topic area will be questioned in detail. The beauty of this is most of these areas are repeated. Say unit trust, primary dealers, insurance, some questions on finance companies, often repeated. Payment system is another repeated question. So you can easily prepare for this repeated. At the same time, certain areas will be tested from time to time. Pawning was twice tested, venture capital twice tested, then cooperative societies twice tested. They are not repeated. So I'm covering the entire syllabus. Now you have to prepare for questions and answers. I'm doing that as much as possible. I see some drawbacks with online in that area, not in the lecturing, but in your answering. Yes, some of you may not be that fast in typing, or some other may be using mobile phones. So there are drawbacks, which I accept. But it's your duty to do these on your own. Now look at the answers you can see in the chat box. I'm very happy with the quality of these answers, and I hope the other students have the same standard as well. Right. Now, we will end the entire lecturing session in this month. So with the end of this month, September, we'll be completing and ending this lecturing session. Okay. So prepare yourself. And I'll add more and more reading materials. It does not mean you have to definitely read them. No. Let's say yesterday I came up with a very good article on unit trusts, a newspaper article. I'll publish that so you can read it. So likewise, many reading materials I'll publish. So that will upgrade the level of your answers. Okay. these reading materials are not compulsory, they're optional, but that will improve your level of writing. Say unit trust. By now you know everything you want to know for this exam, but by reading these things you will get more understanding. So when you're answering, you will show a little bit different from rest of the answers. So you will get more marks by reading these materials. With that, I'll end today's session. Nadini, I'll answer for your question next week. And I think I answered one of your question on these directions. Okay, last week you asked me a question on directions. Yes, certain directions, the examiner expect the exact year and the name, but if you miss that, still you can write something and get a good mark. Okay, with that I'll end today's session. Thank you.